Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, January 19th, 2022, and I am pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are down following the big sell-off yesterday. Currently, Dow futures down 270 points. S&P 500 futures down 34. NASDAQ futures down about 110. On a percentage basis, this ranges from about 0.8% down to 1%, almost 1% on the NASDAQ. Crude oil down 48 cents. We're back down below $80 a barrel, actually all the way down to 79 after being well up into the 80s yesterday. The U.S. 10-year Treasury yield, which took a huge drop yesterday, bouncing back just a little bit up 3 basis points to 3.40%, but we closed at 3.37 yesterday, which was below 340 for the first time since back the early part of September 2022. So yields coming down, bond market maybe looking for a slowing of rate hikes, maybe elimination of rate hikes by the Fed. And the overall market probably looking for a little bit of a slowdown. We've seen some key economic reports of late that have come in way below expectations. I'll talk about that in just a minute. Let's go ahead and walk through today's agenda before we get going. We'll start off with the daily market recap, then talking technically, reversing candles, a lot of those yesterday. Earnings spotlight, we'll wrap up with the three you must see. Do want to take you over to earningsbeats.com, where if you scroll down, want to make sure everyone is aware, we do have a free newsletter. Our Earnings Beats Digest. It's a educational newsletter. I write it 3 times a week. It's very quick read, 2 paragraphs and a chart. Can be used for trading candidates if you so desire. That's completely up to you. But a lot of times just focusing on individual stocks in relation to their relative strength, their recent earnings, maybe upcoming earnings. Talk a lot about candlesticks, volume, price volume, that combination, moving averages, trend lines, and so forth. Things, candlesticks, reversing patterns, things that you would normally think of, at least if you listen to our show here at Earnings Beats. But again, just sign up with your name and email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. We'd love to have you. Okay, so let's move into daily market recap. What happened on Wednesday? Well, it wasn't too bad early, but then it got bad pretty quickly. And we saw some technical damage. We saw some reversing candles. The Dow Jones Industrial Average finished down 613 points, 1.8%. S&P 500 down 62, 1.6%. NASDAQ down 138, down 1.25%. That was a little change in character. The riskier the index, the less it went down. That's something different. We haven't really experienced much over the past few months. Mid caps down 1.25%. That was 32 points. And small caps down 1.5%, down about 19 points. So it was selling across the board, no doubt. All of the 80 lines, which were looking so strong, certainly took a hit yesterday on the increasing volume, maybe slightly increasing volume, and with the major indices finishing on their lows. As far as the sectors go, all 11 were negative yesterday. And the leaders, again, talk about change of character. These are all groups that had been leading the market, or at least doing better. And what I always talk about, either on here or in my articles, my blog articles, or with our members at Earnings Beats, this is opposite George Week. Whatever was not working before tends to work better, and whatever was working before tends not to work now. It's options expiration week. So anything that's been going up tends to have more in the money calls, and that leaves money on the table potentially for market makers to swoop in, bring prices back down, and start to eliminate some of that net in the money call premium. Anything that's been going down has net in the money put premium. And so it's an opportunity for market makers to lift these unhealthy stocks, at least for just a couple of days, and potentially wipe out some of the net in the money put premium. It doesn't just happen once in a while. This has been going on for many, many decades. Options out there have a set period when they expire. And when they expire, you need to be aware of it. It's one of the reasons when I talk about the calendar month and how the stock market tends to do much, much stronger from the 28th to the 6th, 28th of one calendar month to the 6th of the next. It's because a lot of money flows coming in from 401ks and pension funds and all that. Well, when you get to the 19th, 18th, 19th through the 25th, you start to see a period where we normally do not do well. And personally, I think a lot of it has to do with monthly options expiration. Monthly options expire the third Friday of every month. So this Friday will be January 20th. Options expire. And so we tend to start seeing movement down heading into option expiration Friday. And then the worst day of the calendar month historically has always been the Monday that follows options expiration, which will be January 23rd this year. So just keep that in mind. Been talking to members the last couple of days, even though we had this beautiful move up. Remember, the volatility index kind of gave us a little bit of a signal. The market was going down, and so was volatility. The volatility index, that usually doesn't happen. It's telling us fear was coming out of the market. The market took off, just like we were expecting. Well, we had our Max Payne event for members on Tuesday evening, and I said, we got potential downside for the next couple of days, next few days maybe. Doesn't mean it's going down. It doesn't always work, but it's a signal. It's a signal just like a negative divergence, just like a reversing candle, anything. That's what Max Payne provides us, another signal. Tells us that market makers could have financial incentive to do something, either move up, move down, help the market move up or down. They'll commit their own capital. Why wouldn't they? They're on the hook for these options. Any open interest at the CBOE, you got market makers involved. Why wouldn't they try to take prices down if the market's been going up? Weak stocks, why wouldn't they want to try and lift them? If everybody's been playing puts on the weak stocks and been playing calls on the strong stocks, opposite George week, Seinfeld reference. Anyhow, check out the leadership to the downside. Staples, utilities, both defensive groups. Industrials, financials. These were the two aggressive groups that have been working. All of a sudden, they're down. Energy, which had a pretty nice run, pulls back. Where's technology? Where's consumer discretionary? Where's communication services? Well, if you recall, those were getting beaten up in the fourth quarter. They rallied, but they don't have nearly as much in the money call premium as some other areas of the market. Anyway, got to be aware of option expiration week, generally opposite George week, and seems to be playing out again. 10-year Treasury yield. Here was what I was talking about earlier. There's your breakdown below 340. First time the yield has traded below and closed below 340 since all the way back here in the first couple of weeks of September when we were making our way up. Now, if you remember back over the summer, the stock market went up and the bond market went down. But when the bond market started coming back up, the market fell apart. This has been a little bit different this time. We went down. Stock market went up some areas, mostly value. Growth didn't do very well when the rates were coming down. That was really odd. And then rates started going back up. The market struggled. But during this last drop, we've seen growth stocks take off and the whole market go up. But this looks a little bit more extended than this one. This one was only maybe 6 weeks. This looks like maybe 3 months. It's almost twice the length. It's now come back down and taken out 340, which we had a high here at 348. Went back up, came down, tested 340. It looked like we were going to head back up, but no, turned around, rolled back over. So when the yield's going down, that's telling you folks are buying bonds. Okay. You're not going to buy bonds when you've got inflation fears. You're going to buy bonds when you worry more about the economy. So I think what we're seeing here with the 10-year Treasury yield dropping is the market now moving past inflation. You know, this has just been a series of news, whatever you want to talk about. It's not going to be inflation going forward. My opinion. It's going to be all about the recession. And to be honest, if you've been looking at economic reports lately, last week, factory orders dropped 1.8%. They were expected to drop 0.8%. Earlier this week, the Empire State Manufacturing Index was supposed to be down 8.1. It fell 32.9. Yesterday, December PPI came out. Headline number dropped 0.5%. Market was expecting a drop of 0.1%. Strip out food and energy, and the core number was just a rise of 0.1%, which matched expectations. This is 3 months in a row of pretty tame inflation data. December retail sales yesterday, expected to drop 0.8%. They dropped 1.1%. How about December industrial production? Was supposed to drop 0.1%, dropped 0.7%. And November was revised lower from minus 0.2% to minus 0.6%. So they not only said, hey, things are slowing faster in December, but wait a minute, they slowed even further than we thought back in November. And so that took down December's capacity utilization. Supposed to be 79.5, came in at 78.8. The November number was revised lower from 79.7 to 79.4. There's a pattern right now going on in these economic reports. They're coming in much weaker than expected. If the Fed keeps chasing the ghost of inflation and raising rates and continues to kill the economy, we're going to see supply inventories go too far the other way. And my biggest fear is not inflation. My biggest fear is not recession. My biggest fear is deflation. It's really hard. Think back to Japan in the 1990s and how long that stock market went down. In my opinion, that's what the Fed is risking every time they decide to chase inflation. Again, just my opinion. You don't have to agree with me. But I think the Fed needs to halt. And I think the stock market is saying you need to halt. The bond market is saying you need to lower rates, or at least you need to start thinking about it. 10-year Treasury yield moving down now to a 4-month low. Interesting times indeed. We got a Fed meeting coming up the end of this month. Going to be very, very interesting meeting. If they keep talking tough about inflation, I think the market will break back down again. I think currently, looking at the S&P 500, let's move on to talking technically here. Looking at the S&P 500, I mean, yesterday's candle was rough, but honestly, this was to be expected if you follow options. Let me see, I'll pull up. Hold on, bear with me 1 second. I'm going to pull up Max Payne for the Spider and the QQQ. So this is what we went over with our members on Tuesday night, Max Payne. There's the Spider. We were up around 400, closed up, 398 or whatever. 397.77 is where we closed on Tuesday. Max Payne, I told members Max Payne was 388.96. $9 drop. Now, when I calculate Max Payne, I don't say, hey, this is where the market's going to go. Again, I use it as a directional clue. So when I see the Spider trading at 397 and I have Max Payne at 388 and change, the directional clue is that the market could head lower in the near term. It's a option-related event. So when the market paused yesterday printed a new high over 400 and then came back down, closed near the low. And then, and that was on, I guess that was on Tuesday. And then yesterday we saw the big down day. This doesn't surprise me. 2 days ago, when I sent out the daily market report, well, let me back up even further. Back on January 5th, I talked to members and said, this would be a good time to use leveraged ETFs on the long side, if you're so inclined, if you like to take on additional risk, because of the signal the VIX was giving us. After we moved up for about 6 or 7 days, I sent out another note and said, max pain's coming up. We also have negative divergence. Look at the hourly chart on the S&P. As we were going up on Tuesday right here, look at the PPO rolling over. What happened? Market sold off. So we were starting to get multiple signals that said short term, not long term, but short term, we needed a break. We needed a pause. It just means that there's more risk involved and you need to be careful. The QQQ, let me give you the max pain there. So we were trading at the close on Tuesday at 281.54. So right here, 281.54, right? Gapped up yesterday. Look at the PPO. PPO didn't even go up with it. We're rolling over. Saw that selling from 10 to 11 o'clock in the morning, and that just triggered the selling, which probably will eventually take us down here, at least to the 50-hour moving average. But notice the little bit of subtle change here in character. Look at the QQQ on the hourly, still above its 50-hour moving average. The spider below the 50. Through the fourth quarter, it was the opposite. The spider was holding up much better. So that's, maybe one little piece of character change in the market you should be aware of. Look at the diamonds. Remember how strong the diamonds were? Diamonds falling apart right now. Money rotating out of some of those large behemoth multinational companies, those conglomerates. Many of the Dow components got hit hard yesterday. Of course, the Dow overall lost almost 2%. Anyhow, so yeah, the market certainly looks weak here. And sometimes what you need in the short term, this down move, can escalate. So I'd be looking for some sort of reversing candle. I would not just assume the market's going to turn. One positive for the NASDAQ could be Netflix reporting after the bell today. Maybe that we get morning weakness. Maybe we get a big reversal later heading into the Netflix report, because I do think Netflix is going to report strong numbers. We'll see, but the way it's trading on a relative basis, it looks like it's being accumulated by Wall Street. I would not be surprised to see a really good report out of Netflix. But this is where we stand right now. So this move on the S&P, while we broke down on that hourly chart, on the daily chart, we're still above both moving averages. And I'm going to be watching the NASDAQ in particular. But here, if you're looking at the moving averages, we're still well above both. But the 20 is still below the 50. That's not a good, the bullish setup is you want the PPO positive. You want price action above the 20, which is above the 50. We don't have that yet. So there's still some cracks in the foundation here. I believe the bottom is in. I've said that before. I mentioned in my show over at Earnings Beats yesterday, but if you didn't listen in there, I'll mention it again. Since 1950, there have been 14 bear markets, both secular and cyclical. Total of 14 since 1950. 7 of them, if you include October 2022 as being a bottom, 7 of the 14 ended in October. So if you don't include this one, 6 out of the last 13. If you think we're going to keep going lower. I think that was the bottom. The S&P 500, I think at this point, still a little bit clearer. It's a little bit further off from its bottom. But if that does turn out to be the bottom, 7 out of 14 bear markets have ended in the month of October. Listen, we have 12 different calendar months. Take your pick. You get 14 bear markets. Don't you think there'd be a little bit more dispersion throughout the year? The other thing that I talked about at the end of October was, remember, October 27th close to January 18th close, we had gone up 27, or excuse me, I don't know where the 27 came from, 62 of the last 71 years. Let me say that again. From the close on close on October 27th to the close on January 18th, which was yesterday, the S&P 500 had moved higher 62 of the last 71 years. Now we can make it 63 out of 72. I know there were a lot of folks still back here thinking bear market, forget about, the end of the year. I had some folks write in and say, well, what about fourth quarter of 2018 and that bear market? It was a bad fourth quarter. Hey, I didn't say it's perfect, 62 out of 71. I'm just saying the odds are in the favor. The stock market's not about guarantees. The stock market's about risk. It's about probabilities, and it's about managing your risk, managing your capital. I'm not going to look at the market with the signals I was getting all the way back in June, thinking a bottom is going in. I'm not going to think about shorting during the most bullish period of the year. I'm just not. Was it a huge move up? No. I mean, I don't know let's see, where were we? October 27th, we closed at 38.07. We finished at 39.28 yesterday. So that's what, 121 points. And on 38, that's getting close to 3%. 3% move up in 2.5 months. Not bad. Probably a little below average, but most of that was because of yesterday losing 1.5%. Probably would have been a little above average had we not had that day yesterday. Probably would have been up somewhere around 4.5%, which is, I don't know what the average gain is from October 27th to January 18th, but I got to believe it's probably around 4%. Anyway, this year, around 3%. Hold on one second. Sorry about that. Just trying to get some water. All right. So let's move on and talk a little bit about the NASDAQ 100, which shows a bearish engulfing candle. When I see a reversing candle off of an uptrend, I think short-term we're moving lower. Doesn't mean we go down for 3 days, 6 days. Doesn't mean we go back to a new low. It just means that we're going to go lower. It means we could just gap down today and that's it. Or maybe we do go back to the recent lows. But that reversing candle signals that we're not likely to just take back off. I mean, if you look at some of the other reversing candles on this chart, I mean, here's one. Started going up, we gapped up. That was with the CPI report. Printed a black candle. That's a reversing candle off of an uptrend. And down we went. That was a lengthy decline. Maybe this one will be as well. Off of this move to the upside, another black candle. Came back down. This one wasn't quite as bad, just back to the 20-day. We ended up going up higher. Maybe this goes down to the 20-day and we go up higher. I don't know. Short-term signal. But anytime you get these reversing candles, you do have to think about higher prices. Off the downtrend, look at that bullish engulfing candle. What did we do? We rose off of it. Next day, we gapped up, pulled back, but we kept going higher. And even the next day, again, we got the gap up off of that reversal. That's what I've been looking for. Today, the futures are down. Honestly, the way we finished yesterday, I would have been shocked if we had been up today. I would have expected to be down at the open. Do we go down, clear key moving averages across our major indices? That'll be another story. Let's see what happens. All right. Wanted to talk about reversing candles just kind of quickly here. If you go in, actually, let's go back to your dashboard. I want to make sure you know how to get to this. There are a couple of different ways to get to it. But if you're on your dashboard and you go down, go to your scans. Click here and you'll see predefined scans. You just pull that up. So I just wanted to show you where you can go in and look. So let's say we see that reversing candle on the S&P and on the NASDAQ. So how do you find individual stocks with reversing candles? Scroll down, candlestick patterns. Now there's bullish engulfing, but probably not going to see too many of those. Bearish engulfing, 838. Filled black candles, 885. Shooting stars, 175. Lots of bearish reversing patterns. Just click on the index to go take a look at whatever, pull up charts. I just want to make sure that you're aware that that's out there. So that's how you can find some reversing candles. All right, let's take a look at earnings quickly. Tell you what we'll do. Let's look at some of the reactions to earnings. So KMI, this is Kinder Morgan. They reported yesterday after the close, not showing anything on that one at this point this morning. Discover Financial reported yesterday. Oops. Down $8 on Discover. They beat, by the way, or at least they beat on the bottom line. 377 versus 358. Stock down 8%. This morning, Procter & Gamble reported down 3.3%. I have not seen their numbers. I don't know if they beat, missed, whatever. But $140.49, down almost $5 today. Look at that candle yesterday. Definitely looked like we're trying to roll over here. Now we've got maybe the 50-day moving average that we can, see if that holds. But we're going to open up beneath it, so we're going to have to rally from there. But some of these defensive stocks that had been rallying, all of a sudden, opposite George Week, we're getting pullback. Be interesting to see what the max pain was on Procter & Gamble. Usually I don't look at the defensive stocks. I look at more aggressive, more volatile stocks. But anyway, Procter & Gamble having a rough morning. Let's see. Fastenal, another one this morning. Not seeing anything there. What else did we have? TAL had been one that had been moving into earnings. Down 4%. But look at this rally that we had seen. I don't know what they reported. They're down. But I bet they beat top and bottom line just because of the way they had been trading. But I'll look at that later today. All right, let's wrap this thing up. I want to talk first about Tesla because max pain on Tesla was $135. And if you look at Tesla yesterday, we opened at 136, printed a bearish engulfing candle. I would expect we're going to roll back over here on Tesla. We'll see. Coke, another one in the defensive space. Look, broke down, went back up, tested the 20, failed, set a new low. This looks like it's trending lower to me at this point. And then finally, UAL, after a big move to the upside, look at that bearish engulfing candle. Looks to me like we're going to see some weakness. That also occurred right at key resistance. Look for a 20-day test here, back down around 45. All right, that is it for me. I'm about ready to run out of voice anyway, so let's go ahead and wrap this thing up. I appreciate everybody tuning in. That's it for me for the week. Until next Monday, I'll be back over at Earnings Beats. If you want to join my show over at Earnings Beats on Mondays and Wednesdays, come over, click on Trading Places Live anytime between 8:45 and 9 o'clock in the morning, Eastern. And when you come down, instead of seeing this replay, you'll see a Listen Live button. Just click on that. It's free. Just come on in. Love to have you. Anyhow, have a great weekend, everybody. Be careful out there as the market rolls over. Let's see what it's got. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.